And the People's Republic of China has waived 23 interest-free loans borrowed by 17 undisclosed African nations. I know Kenya is part of them, but how significant is the loan that we will be getting an interest-free waiver?
And China is not just only the biggest bilateral lender, but it's also the biggest trading partner. And so whatever China does, we have to look at it. To what extent is it going to affect Kenya and the relation that we have with China?
Trade between China and Africa.
Now, Africa's bilateral trade with China surged to a record high last year.
China has been Africa's top trading partner for 15 consecutive years.
That if there is only one word that can characterize our partnership with China, it is tangible results.
Exceeded $314 billion in the first 11 months of 2025. That's a 17.8% increase in just 1 year.
Across Africa, a quiet but important shift is taking place. Public data from trade ministries, port authorities, and international lenders show that several African countries are taking fewer new loans from China than in previous years. At the same time, export numbers from the continent are rising. Goods are moving out of African ports in larger volumes, and trade links are becoming more diverse. This is happening while China slows its overseas lending and tightens credit conditions at home. For more than a decade, Chinese loans played a major role in African infrastructure. Roads, railways, ports, and power projects were often financed through long-term borrowing. Recently, that flow has changed. Loan approvals have dropped. Existing debts are being restructured in some cases. New projects are moving more slowly. This is not limited to one country or one region. It is a broader trend that financial institutions are tracking closely. At the same time, Africa's export story is changing. Customs data shows growth in agricultural exports, processed minerals, energy products, and manufactured goods. Some countries are shipping more refined products instead of raw materials. Others are entering new markets in Asia, the Middle East, and Latin America. Trade agreements within Africa are also beginning to show results as regional trade increases under continent-wide frameworks. Shipping volumes from key ports have risen. Export earnings have improved in several economies, even as global conditions remain uncertain. This growth is not even across the continent, but the direction is clear. Trade, not borrowing, is becoming a stronger source of foreign income for many African states. China's role is also changing. Chinese companies remain major buyers of African goods, especially minerals and energy. However, the focus is shifting from financing governments to buying products and investing in commercial ventures. Loans are no longer the main tool. This reflects China's own economic pressures, including slower growth, and concerns about debt risk. Chinese lenders are being more cautious and African governments are adjusting. In Europe and North America, this shift is being watched carefully. For years, Western policymakers discussed Africa mainly through the lens of aid, debt relief, and security. Now, trade figures are drawing attention. When exports rise and borrowing falls, it changes the balance of influence. It also changes how financial risk is measured. Markets react to expectations. When Africa depends heavily on loans, creditors have leverage. When export income grows, that leverage weakens. Analysts warn that this trend could reshape negotiations over debt restructuring, development finance, and trade policy. It also affects global supply chains, especially for critical minerals, food products, and energy resources. Some Western companies are increasing their presence in African markets, not as lenders, but as buyers and partners. Others are concerned about losing market share to competitors who move faster. Governments in the West are debating how to respond. Should they offer more trade access, more investment guarantees, or new financing tools? These discussions are ongoing, and no single strategy has emerged. Within Africa, the conversation is practical. Export income brings foreign currency that helps stabilize budgets, pay for imports, and manage existing debt. It can also support local industries and jobs if value is added at home. Policymakers are cautious, but many see trade as a safer long-term path than heavy borrowing. There are still risks. Export growth depends on global demand, prices, and logistics. A sudden drop in commodity prices could hurt revenues. Climate shocks can disrupt agriculture, infrastructure gaps remain, and reduced access to cheap loans can slow large projects. Analysts warn that trade alone is not a solution to every problem. Still, the current moment matters. When loan flows slow and exports rise at the same time, it signals a change in economic behavior. Governments are prioritizing earnings over easy credit. Businesses are looking outward. Ports, customs systems, and trade finance are becoming more important than before. This shift also affects geopolitics. Influence today is not only about military power or political statements, it is about who buys, who sells, and who sets the rules of trade. If African exports continue to surge, negotiating power increases. Countries with strong trade positions can choose partners more freely. That creates uncertainty for those used to setting the terms. In financial centers, risk models are being updated. Debt ratios look different when export revenues grow. Currency stability improves when dollars and euros come in through trade instead of loans. This could mean better credit ratings over time, though progress will likely be uneven. China's reduced lending does not mean disengagement. Trade ties remain deep, but the relationship is becoming more commercial and less financial. For Africa, this could mean fewer debt pressures tied to single lenders. For the West, it raises questions about competition and relevance. Public opinion across Africa is also part of the story. There is growing awareness of debt costs and repayment burdens. Export success is often seen as earned income rather than borrowed money. That perception matters for domestic politics and long-term planning, even when leaders avoid strong public statements. Looking ahead, the key question is sustainability. Can export growth continue without new debt-fueled infrastructure? Can regional trade deepen fast enough to cushion global shocks? And can external partners adapt to an Africa that prefers trade deals over loan packages? This could mean a rebalancing of global economic relationships. It could also mean new tensions as countries adjust to a different Africa, one that is more focused on selling goods than signing loan agreements. As the numbers continue to come in, the trend is becoming harder to ignore. Africa is choosing trade over debt, at least for now. China is lending less, exports are rising, and traditional power centers are reassessing their approach. The question for viewers is this: if Africa's future influence is increasingly built on trade rather than borrowing, how should the rest of the world respond, and who will adapt fast enough to keep up? The global economic map is shifting again, and this time the change is coming quietly from Africa. Recent trade and finance data shows a clear movement away from heavy reliance on foreign loans and toward stronger export activity. Chinese lending to African governments has slowed sharply compared to previous years, while exports from multiple African economies are rising at the same time. This combination is drawing attention far beyond the continent. For years, loans were central to Africa's development story. Large infrastructure projects were often financed through borrowing, with repayment spread over decades. That model is now under pressure. Chinese financial institutions have reduced new loan commitments, tightened conditions, and focused more on managing existing debt. This is happening as China deals with its own economic adjustments and reassesses financial risks abroad. What makes this moment different is what is happening alongside the slowdown in loans. African exports are increasing, not just in raw materials, but in processed goods, agricultural products, and manufactured items. Port traffic is up in several regions. Trade revenues are growing in countries that once depended mainly on borrowing to fill budget gaps. These changes are visible in customs figures, shipping records, and balance of payments data. Minerals, energy products, food crops, and industrial inputs are moving to markets in Asia, the Middle East, and within Africa itself. Regional trade agreements are starting to show measurable results, reducing dependence on distant partners and creating new supply chains closer to home. China remains a major trading partner, but the relationship is evolving. Instead of large-scale government loans, the focus is shifting toward commercial trade, private investment, and joint ventures. This reduces direct debt exposure for African states while keeping trade channels open. Analysts warn that this change reflects caution on both sides rather than a sudden break. In Western capitals, this development is causing unease. For decades, influence was often exercised through lending, aid programs, and financial conditions. When countries rely less on loans and more on export income, that leverage weakens. Trade-driven economies negotiate differently. They have alternatives, options, and greater flexibility. Financial markets are paying close attention. Export earnings bring in foreign currency, which supports exchange rates and stabilizes government finances. When exports grow faster than debt, risk profiles improve. Credit assessments begin to shift, even if slowly. This could mean lower borrowing costs in the future, but only if export growth proves durable. Inside Africa, policymakers are cautious but focused. Export income is viewed as more sustainable than borrowing. It pays for imports, supports domestic industries, and helps manage existing debt without adding new obligations. Governments are investing more in ports, customs systems, logistics, and trade facilitation rather than relying solely on external financing. There are challenges. Export growth depends on global demand and prices, which can change quickly. Commodity markets are volatile. Climate risks threaten agriculture. Infrastructure gaps still limit production in some regions. Reduced access to large loans can delay major projects. Analysts warn that trade-led growth requires discipline, planning, and diversification. Even so, the direction is clear. More African economies are prioritizing what they can sell over how much they can borrow. This is changing conversations with international partners. Negotiations increasingly focus on market access, standards, and value chains instead of debt terms. Western companies are responding in different ways. Some are expanding sourcing operations and partnerships. Others are concerned about competition from faster-moving rivals. Governments are debating new trade initiatives, investment guarantees, and strategic partnerships to remain relevant in a changing environment. This shift also affects global supply chains. Africa is rich in resources critical to modern industries, from energy to technology. As exports rise, African producers gain bargaining power. Prices, contracts, and delivery terms become negotiation points rather than fixed outcomes. Public opinion across the continent plays a role as well. Debt burdens are widely discussed, and export success is often seen as earned growth rather than dependency. That perception influences policy choices and long-term strategies, even when leaders avoid dramatic public language. Geopolitically, trade is influence. Those who buy and sell shape standards, routes, and alliances. If Africa continues on this path, global power dynamics adjust. Countries accustomed to setting terms must now compete. China's reduced lending does not mean withdrawal. Trade volumes remain significant, but the balance has shifted. For Africa, this could mean fewer debt-related pressures tied to single partners. For others, it raises concerns about losing economic ground. The long-term outcome is still uncertain. Export growth must be sustained and broadened. Value addition must increase. Regional integration must deepen. Analysts warn that without these steps, gains could stall. Still, this moment matters. Africa is signaling a preference for trade over debt. Loans are no longer the default option. Exports are becoming the center of economic planning. Traditional power centers are watching closely, reassessing strategies, and adjusting expectations. As this trend continues, the world faces a new reality. Africa is not just a destination for finance, it is an active trading force shaping its own future. The question is, if trade, not debt, becomes Africa's main source of influence, which global partners will adapt to this change, and which will be left reacting too late?